Hi everybody, this is Lara with your weekly video for the S&P 500 for the trading week ending 1st of November 2019. Targets are adjusted, a little bit more attention is given to what to expect in terms of pullbacks along the way up in this bull market. I've been expecting new all-time highs for a while now and we finally got them this week. The next target for a reasonable sized pullback, which may last over a couple of weeks, is at 3179. Overall, along the way up to end this bull market in coming months, I'm expecting 3 more big consolidations or pullbacks. And we're not quite there yet. I'm not expecting it to begin next week. The Elliott Wave count sees this bull market beginning in March 2009 as the simplest Elliott Wave structure, a 5-wave impulse. Cycle wave 1 of this impulse is off to the left of the chart. It ends in the last week of November 2014. Cycle 2, a combination, ends here. Cycle 3 here. Cycle 4, a double zigzag. And cycle 5 is an incomplete structure. When cycle 5 is complete, it should look like an obvious 5-wave structure. And so each of these second wave corrections needs to have a counterpart 4th wave so that you can count the waves as an obvious 5-wave structure. I did have an alternate which looked at the other structural possibility, still a 5, but this one sees cycle 5 as an impulse. My alternate considered an ending diagonal. With a new all-time high this week, their alternate has been invalidated, leaving now only one structure at this stage possible for cycle wave 5. When you label cycle waves 1, 2, 3 and 4 in these positions, you then draw an Elliott channel around this impulse. The first trend line is drawn from 1, last candlestick in November 2014, to 3, and then a copy is placed on 2. When you do that, it perfectly shows where 4 finally found support and formed this perfect V bottom. That tells me that 1, 2, 3 and 4 are most likely put in the correct positions, and there's a really important implication from that. 3 is shorter than 1. A core Elliott wave rule states that this third wave may not be the shortest out of 1, 3 and 5, so that tells us that 5 is limited to no longer than equality in length with 3 at 3477.39. That's a really important point for this Elliott wave count. I do have alternates at the monthly chart level which don't have that limit and are more bullish, but they don't have this perfect channel that this wave count does, which is why it's my main wave count. And so this limit has an effect on my target calculations for the ends of my third waves, which has an effect on when I am expecting a deeper pullback or a more time-consuming consolidation to arrive. Within the middle of the third wave, no second wave correction may move beyond its start below this price point. Let's take a look at cycle wave 5 from the end of intermediate 1 at the daily chart level. This high up here, here's a zigzag for intermediate 2. Intermediate 3 should now be underway. I've adjusted the target for intermediate 3 to consider this new target for minor 3. The target for intermediate 3 is now for it to reach 1.618, the length of intermediate 1. This target is not far, but it is still below the target for primary 3 to reach equality in length with primary 1, and they all fit with this limit for cycle wave 5 to not be longer than equality in length with cycle 3. Minor wave 2 lasted 2 weeks, and it was a relatively deep zigzag. When it arrives, minor wave 4 must remain above minor wave 1 price territory. So once minor 3 has moved far enough above this point is then going to be expected to provide extremely strong resistance or support and to not be breached for the Elliott wave count to remain valid. The target for minor 3 for it to reach 1.618, the length of minor 1, would allow plenty of room for minor 4 to unfold and remain above minor 1 price territory. Likewise, when intermediate 3 is complete, intermediate 4 probably a shallow sideways consolidation, should then be expected to last a few weeks and remain above intermediate 1 price territory. Another way of saying all of that is that now that resistance has been breached, once prices moved far enough away from this area, deeper pullbacks will be expected to remain above these price points. Minor wave 2 lasted 2 weeks. I'll expect minor 4 to last about 1, 3 or maybe even 5 weeks, probably to be a more time-consuming sideways structure like a combination or a triangle. For the S&P, fourth waves can often be more time-consuming. Second waves are most commonly zigzags, and zigzags tend to be quick structures. Fourth waves are often complicated combinations, triangles or flats, and they can be shallow and more time-consuming. I've moved the degree of labelling here down 1 degree because it fits with this target, and it expects that upward momentum for the middle of this third wave at multiple degrees should be expected to exhibit strength and be stronger than the first waves. It allows for MACD to move higher to support the wave count. We're not there yet, but that's the expectation. This Elliott wave count is, the purpose of it is predictive. Minor wave 3 needs to subdivide as a simple impulse. We may have minute 1 and 2 and 3 incomplete. When 4 arrives, it has to remain above 1 price territory, which has its high at this candlestick here. Importantly, not this one here. It'll probably be quite shallow, and then a fifth wave up toward this target. If any of my labelling in here is wrong and we're yet to see another deep time-consuming second wave, it can't move beyond the start of the first wave below the invalidation point. At the hourly chart level, here's the end of minute 2. Here's a possibly incomplete minuet 1 within minute 3. I've moved the degree of labelling here down 1 degree. The channel is still essentially the same. Here it's correctly termed an acceleration channel from the end of minute 1 to the last high, and then place a copy on the end of minute 2, and as price keeps on going higher, keep redrawing that channel. When minute 3 is complete, it will be an Elliott channel, and along the way up, continue to expect pullbacks to find support about the lower edge of the channel. When minuet 1 is complete, a deeper, more time-consuming pullback, possibly to be over intraday, for another little second wave correction may be expected. At the weekly chart level, this wave count moves the entirety of the bull market all down 1 degree instead of grand supercycle 1 coming to an end and to be followed by grand supercycle 2, a devastating bear market. We could only be looking at the end of cycle wave 1 within grand super or within supercycle 5, to be followed by a relatively brief and shallow bear market and then a continuation of the bull market for many more years. This is entirely possible and may actually have a little bit more support from classic technical analysis. We'll get to that when we get to the AD line. Short-term targets and validation points and the limit are exactly the same, and I'm still expecting the whole structure of this fifth wave to take many more months, maybe even over a year, still to complete, because these corrections are quite time consuming. There's going to be more of them because markets don't move in straight lines. This is all entirely normal. Once a month, at the beginning of each new month, I'm going to publish a technical analysis monthly chart. That was a great suggestion from Rodney, so thanks for that. And this is a really good idea to keep our eye on the bigger picture. This is March 2009. This is the end of that bear market, the global financial crisis, or whatever you want to call it, and the start of this bull market, which has now lasted over 10 years. Along the way up, price does not move in straight lines. There are time-consuming and deep pullbacks and consolidations, big sideways one here along the way. That is absolutely normal and to be expected. Elliott Wave is quite useful here, and when we count the waves, we can try and figure out when the last of these corrections may be over. This big consolidation here is a simple technical concept. The longer price spends within a sideways consolidation, the longer the resulting breakout after a breakout will be. Also note that after price broke above resistance on this month here, that doesn't mean that price can't move back into that territory and retest lower support lines in here. It did so here for a couple of months here before it finally moved well up and away. Again, a really time-consuming consolidation. The breakout in this month here, price did move slightly back into this zone here, but not by much, before it moved up and away. We've had another quite a time-consuming big sideways consolidation lasting over a year. We've got a strong breakout on Friday. Price can certainly come back down into here to test support in here. There's quite a few support lines in here before finally moving up and away. The longer price spends within these big consolidations, the longer the resulting movement out of them eventually after a breakout may be expected to be. I had a play with how to draw a good support line for this bull market. Drawing it from here to here bisects up in here, and I think that's got too strong a slope. I'm going to be more conservative and draw a bull market trend line along here and expect that any deeper unexpected movements may find eventual support down at this line. I've said often at the daily and weekly chart level, but this monthly chart shows it so well, that this bull market has been declining on price has been rising on light and declining volume for years now. We have bearish moves, volume has increased, and then bullish moves and volume again declining. Not so obviously in here, but we've been in a sideways consolidation. Let's see if volume is going to start to support this upward movement. In terms of the Elliott Wave count, it sees this, I think it was this point here, as the end of a third wave, and that corresponds, this portion of the movement didn't have quite as much decline in volume. It wasn't as stark as this here. There is some bearish divergence still evident between price and RSI. That can continue further. Sometimes it just disappears, but at this stage, with the data in hand, there is quite strong bearish divergence between price and RSI. It doesn't mean price can't continue to make new all-time highs. Friday's proven it obviously can make new all-time highs because it did, and the bearish divergence could weaken or it could develop further. I would expect, as a fifth wave of an aged bull market continues, for this kind of divergence to develop even further. On balance volume for last month did make a new all-time high. This is the completed month of October. At the monthly chart level, that high has support from on balance volume confirming it. On balance volume is constrained. ADX has been declining. His price has been essentially moving sideways for over a year. The DX lines are whipsawing. No clear trend at this time frame, while price has been moving sideways at this time frame. ATR normally rises during corrections for this market. It rose during this movement here. It rose here while price was moving strongly lower, and now it's flattening off and maybe beginning to decline. If we've got this breakout and we're going to start to see upward movement, that would be absolutely normal for this market. At the weekly chart level, we've got a strong upward day to end the week with new all-time highs. This week, upward movement does have support from volume. There's an almost shaven head on this weekly candlestick. Not really a long lower wick, but the shaven head is bullish, volume is bullish. On balance volume, however, is not. It is constrained. There is resistance here, and at the weekly chart level it has failed to match the new all-time highs from price. Not by a great margin, but it's pretty obvious at this time frame, but it isn't at the monthly chart level. Now this could mean that we're going to get a more time-consuming consolidation or a pullback to be a little bit more long-lasting here. It absolutely on its own does not mean the bull market has to end. That would just be too much of a reach, but it is a warning. There will be pullbacks and consolidations along the way, and here's a warning, we could have one coming up sooner rather than later. And if that happens, take it as an opportunity. RSI is neutral. There is plenty of room for price to rise or fall. There's still this longer term divergence. Not really between here and here. This is a little bit higher here, but there is still longer term divergence. I will expect that to develop further as this bull market continues. ADX is too low to indicate a trend at this time frame. MACD is bullish. At the daily chart level, there is a pretty strong upward breakout to new all-time highs on Friday, a break above this small little consolidation with a gap, we'll call a breakaway gap at this stage until proven otherwise. The last gap was a breakaway gap above this support, or what was resistance line is now support. It was closed here, renamed an exhaustion gap, but it wasn't followed by much more downward movement. After closure, it was only followed by one more downward day, and now an upward breakout. Let's expect support to be quite likely fairly strong at the upper edge of this gap, the high for this candlestick. Below that, strong support, about 3027, should be evident now. Overall, there is a little bit of rise in volume as price is rising. Not so much for Friday, but it is stronger than these days back down here. ADX is indicating that there at the daily chart level there is an upward trend in its very early stages. This is the strongest signal ADX can give when it comes from low levels and rises up from below both directional lines. And since the strength way back down here, I have been expecting that these lows would be sustained, and we have seen upward movement to new all-time highs. Now that we have a new all-time high and resistance has been overcome, I'll expect some release of energy and some more upward movement as most likely. At the daily chart level, the new all-time high has not been matched by on-balance volume. The difference is really slight though, so I'm not actually going to give it too much weight. And I would expect at this age of this bull market and the structure of the Elliott Wave structure coming toward the middle and then the end of a fifth wave to start to see some weakness develop outside of inverted VIX, which there's a lot of weakness there now. And so on its own, I'm not going to say that we have to have a pullback immediately. I'm going to expect that the break to a new all-time high with strength on this day is possibly going to see some further upward energy released. If on-balance volume can make a new all-time high, it would then confirm the highs in price, but it has not done so yet, and there's some resistance for it to overcome first. RSI is still not overbought. There's plenty of room for price to continue higher with this upward trend, and it can reach deeply overbought and remain there for quite a long period of time when this market has a strong bullish trend, because the S&P has a bullish bias. MACD is fully bullish, stochastics is overbought, but because ADX is telling us there's a trend, I do not give this weight. It can remain extreme for quite a long period of time. This week, the new all-time highs in price have finally new all-time highs in price, which were predicted by all-time highs from the AD line, and so now they're finally matching. The AD line shows, with new all-time highs, that upward movement from price has support from solid rising market breadth, and that is bullish. At the daily chart level as well, there is no divergence. The AD line is rising very strongly, as is price rising to new all-time highs. Inverted VIX, however, shows now over 2 years of bearish divergence. It's proven to not be helpful in timing an end to this bull market at all, but I will expect this divergence to continue to develop further. This may be one of the earliest warnings of the beginning of a process of forming a market top. When we see something like this between price and the AD line, then I'll be more serious about calling for an end to the bull market, but that is absolutely not the case yet. What this is telling us is as price is rising, inverted VIX is not rising to the same level. In other words, VIX is declining, but not as fast as price is rising. VIX remains elevated. That's a warning that there's more volatility approaching eventually when the bull market ends and the bear market begins. But we are not there yet. We need other things to line up as well before we can expect this is going to be the case. And there's midterm divergence between inverted VIX and price, but it's not proven to be particularly helpful in timing an end to movements until it gets to be quite strong. And at this stage, we don't have enough of this to tell me that we're going to have an end. That's all for me with your S&P analysis this week. I hope all of our members are having a fabulous weekend.